Subsequent events represent transactions or events occurring between the reporting date and the date of the auditor's report, and in certain circumstances, events discovered after the auditor's report has been issued. These events may significantly affect the financial statements and the auditor's opinion if they provide additional evidence regarding conditions existing at the reporting date or indicate circumstances requiring disclosure. ISA 560 Subsequent events establishes the auditor's responsibilities for identifying and evaluating such events to ensure that the financial statements are not materially misstated before the audit opinion is expressed. Since financial statements are intended to provide reliable information about the entity's financial position at the reporting date, the consideration of subsequent events is an essential element of audit completion procedures and contributes to the overall quality and credibility of financial reporting. The primary purpose of a subsequent events review is to determine whether events occurring after the reporting date require adjustment of the financial statements or disclosure within the accompanying notes. Accounting standards distinguish between adjusting events, which provide additional evidence of conditions that existed at the reporting date, and non-adjusting events, which arise after the reporting date and relate to conditions that develop subsequently. Adjusting events require amendment of the financial statements because they confirm circumstances already existing at year-end, whereas non-adjusting events generally require disclosure only if they are material to users' understanding of the entity's financial position and future prospects. The subsequent events review therefore ensures that the financial statements present a true and fair view by incorporating all material information available before the auditor signs the report. Examples of adjusting subsequent events include the bankruptcy of a customer confirming that a receivable was impaired at the reporting date, settlement of litigation providing evidence regarding an existing obligation, discovery of fraud or accounting errors relating to the reporting period, or receipt of information confirming inventory obsolescence existing at year-end. These events provide additional evidence regarding conditions already present and therefore require adjustment of financial statement amounts. In contrast, non-adjusting events include major business acquisitions, natural disasters occurring after year-end, significant share issues, destruction of assets after the reporting date, or changes in taxation legislation introduced after year-end. Such events do not affect the financial position at the reporting date but may require disclosure if their omission could influence users' economic decisions. The auditor's responsibility regarding subsequent events extends from the reporting date until the date of the auditor's report. During this period, the auditor must perform procedures designed to identify events that may require adjustment or disclosure in the financial statements. The auditor is not required to perform continuous audit procedures after signing the audit report. However, if facts become known after the auditor's report date but before the financial statements are issued that will have affected the audit opinion, appropriate action must be taken. This may involve discussing the matter with management, requesting amendment of the financial statements, performing additional audit procedures, and issuing a revised auditor's report where necessary. The auditor's responsibilities therefore continue until the financial statements are formally issued to users. Where material facts become known after the financial statements have been issued, the auditor generally has no ongoing obligation to search for subsequent events. Nevertheless, if the auditor becomes aware of information indicating that the financial statements may be materially misstated, the matter should be discussed with management and those charged with governance. If management agrees to amend the financial statements, the auditor performs necessary audit procedures and issues an updated report where appropriate. If management refuses to take corrective action, the auditor may seek legal advice, notify regulators where required, or take steps to prevent continued reliance on the previously issued auditor's report. Such situations are uncommon but highlight the continuing importance of professional judgment and ethical responsibility throughout the reporting process. A comprehensive subsequent events review requires the performance of several specific audit procedures. Auditors should obtain an understanding of management's procedures for identifying subsequent events and inquire whether any significant events have occurred since the reporting date. Review of board minutes, management meeting minutes, shareholder resolutions, and audit committee discussions may reveal important transactions or developments affecting the financial statements. Inspection of post-year-end management accounts, budgets, cash flow forecasts, and interim financial information may identify unusual fluctuations or significant business developments requiring further investigation. Analytical procedures comparing post-year-end financial performance with expectations may also reveal events indicating material adjustments or disclosures. Additional audit procedures include examining post-year-end cash receipts and payments, reviewing significant contracts entered into after year-end, inspecting legal correspondence concerning litigation, confirming outstanding borrowings and financing arrangements, and evaluating major asset acquisitions or disposals occurring before the auditor's report date. Auditors should also inquire of legal advisors regarding litigation developments, assess insurance claims arising after year-end, review correspondence with regulators, and evaluate compliance with loan covenants or financing agreements. Particular attention should be given to events affecting the going concern assumption, such as significant trading losses, financing difficulties, loss of major customers, or withdrawal of credit facilities, as these may require enhanced disclosures or modification of management's going concern assessment. Written management representations form an important component of subsequent events procedures. Before signing the auditor's report, management should confirm that all events requiring adjustment or disclosure have been identified and appropriately reflected within the financial statements. Although management representations provide useful supporting evidence, they do not replace other substantive audit procedures and should be corroborated by independent evidence wherever possible. The auditor should also review the final version of the financial statements to ensure that all required disclosures relating to subsequent events have been appropriately included and accurately described. The subsequent events review plays a critical role in ensuring that financial statements remain reliable up to the date of the auditor's report. By identifying adjusting and non-adjusting events, evaluating their financial reporting implications, and performing appropriate audit procedures before completing the engagement, auditors enhance the accuracy, transparency, and credibility of financial reporting. Effective consideration of subsequent events supports compliance with international standards on auditing, protects stakeholder interests, and reinforces public confidence in the independent audit process.